Jared Kaiser, the Chief Investment Officer for Buckingham Strategic Wealth. Thanks again for coming out. I know we've had quite a few investment strategy-oriented sessions, so we wanted to close out basically with one more that's really focused on giving you an overview of what the investment committee looks like at this point in terms of composition. So you'll see I'm going to lead off here basically going through kind of who is the investment committee at this point, just to have everybody on the same page, since there's going to be some new names for the BAM folks, some new names for the Loring Ward folks, so we'll tackle that. Then Kevin and Jonathan are going to be going through kind of the history of our investment committees, respective committees leading up to now, to give you a sense of just kind of knowledge that some of you don't know, again, depending upon which side of the ledger you fall on from an advisory services side. But the vast majority of your time, I like to describe this as a choose-your-own-adventure. We've got a lot of Q&A time built in, so be thinking about questions that you have. We definitely wanted that to be the bulk of the time today, to basically just have you think about what questions do you have for us once you see the committee, what would be helpful to talk through, and that's just kind of open-ended on the investment committee and strategy side in terms of Q&A. Daniel Campbell will be facilitating that. Again, a good bit of time budgeted there. We'll have some starter questions, but again, open-ended time there, so be thinking about what would be helpful to have one of us speak to. Okay, so committee members, just a few slides here. So we got 8 total people at this point. So I actually chair the committee and have for a few years on the BAM side at this point. So briefly, been at Buckingham and BAM basically since 2003, other than a 2-year stint for an institutional fixed income manager in St. Louis. So a good chunk of time at this point, mostly on the investment strategy side, but did spend some time basically on the wealth advisory side in my early days at the firm. So we got Kevin, again, who many of you know, Director of Investment Strategy, so he's kind of the person that certainly involved with the committee, but also leading a number of the teams internally that are investment strategy focused. Jonathan Scheid and Sheldon added from the Loring Ward side as we've integrated. I know many of you know both of those names, so we're looking forward to having them be involved with the committee. And you see there both Kevin and Jonathan have the CFA designation. So far and away, our most famous celebrity committee member is Larry, who I'm sure all of you know either directly or indirectly. He's still heavily involved with the investment committee. Again, I've been around Larry since 2003. He's just as involved today on the investment strategy side as he was there, and I expect that will continue. Talked about Sheldon. There, Tim Jost from our institutional services team at Buckingham, maybe a name that not many of you know, but I've worked really closely with Tim, and he's a fairly recent addition to the committee, holds his CFA, and expect him to make more and more contributions there as time passes. So last 2 members, we got Brian Haywood from our fixed income team. Again, many of you already know Brian. Brian's been on the fixed income team for a long time, basically when he started at the firm, and on the investment committee for a long period of time too, and expect he'll continue to be involved on the investment committee side as a nice liaison between the committee and the fixed income team that we have that's managing individual bond portfolios. And then most recent addition, Susan, so wealth advisory and team lead. I think the context here is we historically, again, pre-integration, have tried to have like 2 to 3 wealth advisory folks where that's their primary role that are part of the committee to make sure we're as grounded as we can be in terms of the realities of client conversations, the questions that are getting asked, so we're not too ivory towerish and are able to basically keep things grounded. So we got basically one a person on the committee now that's a wealth advisor is their primary role. Should also mention, I know this is true for both Jonathan and Sheldon, but Larry, Kevin, and I also spend a huge amount of time, even in the good years, especially years like this year, talking to clients, advisors. That's a huge part of what we do on a year-to-year basis. So we try to make sure that we've got that connection to kind of the client experience, what wealth advisory teams are out there dealing with. Last thing I'll mention, we have investment strategy teams and the PSR teams not reflected on the committee membership here, but are hugely important aspects of what we're doing. Again, I know all of you have interacted with either one or both of those teams up to now, and I think of them as basically the arm of the investment committee that's helping us be able to do the work that we need to do and drive initiatives forward. So we've got a very good group of folks kind of behind the investment committee here. Okay, so before I hand it off to Kevin to go through some of the history for Buckingham and BAM leading up to now, so just wanted to hit on briefly kind of the responsibilities of the committee. And I know I see Jake here, so I want to get the compliance piece in here that this is technically Buckingham's investment policy committee. So when I think about what we're primarily tasked with, it is setting investment strategy for Buckingham, and then of course sharing that out broadly and thoroughly with the advisory services side of our business. And when I think about what we're trying to do for the Buckingham side of what we're doing, it's basically the goal is ideally to make investment strategy and its implementation as black and white as possible, so that advisory teams are not having to spend a significant amount of time trying to figure out exactly what they should be doing on the investment strategy side. Now, admittedly, it's never going to be perfect. When you're a firm the size that we are, you try to work toward that goal, and that's certainly what we're trying to do on the Buckingham side of the business. So if you look at other responsibilities, kind of the ones that you would probably expect, one of the things that I think has worked really well so far on the integration side is very similar philosophically, and we'll get into that a little bit later in terms of the BAM Loring Ward integration. But a lot of what we're trying to do, particularly as the year progresses outside of our regular quarterly meetings, is trying to stay on top of what does the industry, academic, fund company research have to say about what we're doing. So I know all of us will typically spend, particularly the core members, will spend a lot of time throughout the course of the year trying to stay on top of what is that peer-reviewed research saying about investment strategy compared to what we're actually doing, and trying to figure out how we bring those things to life. Certainly a big integration initiative is going to be the capital markets assumption side. So as you might imagine, again, we'll get into this a little bit more later, we didn't have identical capital market assumption methodologies. So I know Sheldon, a number of folks on the committee will be shortly kind of working through what does integration on the capital market assumptions side look like. But that's certainly something that's in the domain of a process that we're going through each year at the committee level. Again, probably goes without saying, creation and maintenance of the model portfolio strategies, which we'll get in a little bit into more deeply here a little bit later. We've got a wide range of models at this point, so there's a lot of energy that we're expending here and on the PSR and investment analysis teams to try to maintain those over time. Monitoring oversight of individual fund managers. Again, we spend a significant amount of time there with the fund managers that we work with, and we'll get a preview from Kevin in terms of who that group basically is. Not obviously a huge group of different fund companies at this point, but a significant number that we're certainly staying in touch with. And I'll skip the next to last one, just touch on the last one, since it'll certainly be important for any folks on the Loring Ward side that will ultimately be using our fixed income offering. So the fixed income team oversight does come from investment committee down to the fixed income group. Again, mentioned Brian as part of the investment committee, but certainly since we're there, we're managing individual bonds directly for a lot of clients and a lot of assets. We do spend a lot of committee time thinking about there, where again, we're directly implementing what should we be doing on the fixed income side and making sure that we're implementing in a fiduciary way and cognizant of what we should be doing there. So with that, I will hand it off here to Kevin to talk about kind of the history of Buckingham up to now.
Thank you very much, Jared. So by means of a brief introduction for those I haven't met yet, as Jared mentioned, I've been with Buckingham and BAM now for about 12 years, going back to 2007. I've had experiences on a wealth advisory team, but I've spent most of my time working with our investment strategy group, as well as our fixed income trading department. And I thought, instead of just kind of being hyper-focused in on the Buckingham and BAM IPC, I could expand this out a little bit to share kind of the history of BAM for those that are from kind of the legacy Loring Ward side and aren't as familiar with kind of our history and how the firms got started from the very beginning. So our firm was founded back in 1994 as a registered investment advisor by 2 CPAs and then 2 other entrepreneurs. Founded Buckingham back in 1994, and really where that idea came from was largely from the 2 CPA co-founders who had a lot of experience and had very successful practices doing taxes and other accounting related work for their clients, and as part of that they would often get asked to produce financial plans for their clients, and they would produce the financial plan. The clients would go off and get it implemented, and you kind of pick wherever they would go to get that implemented, whether it's to a broker, insurance agent, advisor, wherever that might be. That client would come back a year later, and of course, because they're doing the taxes, they can see exactly how that plan is being implemented. And if you think back to the early 1990s, odds are that would be in either high-cost variable annuity, very high-cost mutual funds, or if it's in individual stocks, it's being traded quite a bit. And from seeing the tax side, they can see just all the churn and short-term capital gains that are happening within the account. So they saw a business opportunity to start a registered investment advisor, and they did that back in 1994. And so that's where the Buckingham business was really started, as a registered investment advisor back in 94. So you fast forward a few years, and I've got this timeline up. You fast forward to 1997, which was when Larry Swedroe joined the firm. So he's currently our chief research officer. I believe I have that correct. He joined the firm back in 1997 after essentially being retired from an already very successful career in finance and in capital markets. So he has experience running a currency trading room. He was involved in the mortgage business, both from a trading aspect and just the kind of the general mortgage business itself. So he was effectively already retired 20 plus years ago, but he got connected with the founders of Buckingham and joined the firm back in 1997 to really provide that deep investment strategy expertise. So we're running back to 94. Pretty early on, Buckingham was using dimensional fund advisors, not immediately when we were founded, but shortly thereafter. But the reality was that the founders of Buckingham didn't really have a ton of capital markets experience or investment strategy experience. So they brought Larry on really for 2 purposes. One was for that investment strategy expertise, but then also to provide kind of a marketing arm, a marketing engine for the firm. And so one of Larry's biggest early book was The Only Guide You'll Ever Need for a Winning Investment Strategy. And I know, there are lots of associates, lots of clients at the firm, myself included, that are with Buckingham and BAM because of that book. That's how we sort of discovered Buckingham and BAM to begin with. And he wrote that book back in the mid to late 1990s. And if you think back to that point in time, he was one of the few voices really arguing for an evidence-based or passive approach back then. It sort of seems like a foregone conclusion now that all of these dollars would move from active to passive, but that wasn't so going back 20 plus years. And so you think back to then, it was basically Larry, maybe John Bogle with Common Sense on Mutual Funds, and maybe a random walk down Wall Street with Mal Keel. But other than that, that was basically it. So Larry was very, very early in terms of being a leading voice, arguing against high fee, high turnover active management and arguing in favor of more passive evidence-based oriented strategies. And that's what really led to a lot of Buckingham and BAM's growth over the years. Also, right around 97 was when BAM was founded. So BAM was founded really to help support CPA firms that wanted to get into the wealth management business. And so after a few years, Buckingham had become successful, and some of our co-founders, former CPA colleagues, started to ask, well, how did you get into the business? And so again, they saw a business opportunity to provide infrastructure, provide the lessons that they learned from getting this business started to help other advisors. So back when I started at BAM in 2007, almost all of our clients were CPA-affiliated wealth management firms, and that's no longer as true as it was then, but still it's 70+% of the BAM side's clients are CPA-affiliated registered investment advisors. So that still really is kind of the base of our clients. But as you kind of fast forward from 1997, I'd say the first big shift that we made in our investment strategy was to begin offering individual bond portfolios to our clients. And that was really driven a good bit by client demand. So as we started to work with larger and larger relationships, they started to ask and want an individual bond laddered portfolio. And so we looked at the available options out in the marketplace. We weren't really satisfied with really anything that was out there. So you could, even at that time, you could go to a separate account manager, but the fees were quite high back then, again, going back to the early 2000s. And so we decided to create our own strategy, both because of the fees, but also because you couldn't get the same degree of flexibility or customization that we're able to get with our strategy. So with our strategy, again, the folks on the legacy BAM side know this really well. In a taxable account, we might be buying a municipal bond for a client. We might be buying a taxable bond for a client. It just depends on the client's tax rate, what yields are at that point in time. And so we're able to offer a truly customized bond solution that just isn't, even today, is not available out on the marketplace, where you can find a manager that will mix and match tax-exempt and taxable securities within a single account. So we decided to create something ourselves. It wasn't the easy way, but we felt like it was what was best for clients. Another choice we made back at that time was to not just purchase from the custodian. So that could be a potential option as well. We looked at that as well, but you don't get all that great execution when you do that. So the way we do it is by putting 20 different broker-dealers in competition with one another to get the best bond at the best price for our clients. And that was really the first big deviation from having a basically 100% mutual fund oriented portfolio to move into something where we're actually buying individual securities. And so I've highlighted a few of the other changes that have happened over time, and really I'm talking more about changes to the portfolio. Certainly there have been changes to the membership over time. I do think one shift has been, going back to the early days, almost the entire committee was made up of wealth advisors who essentially did investment strategy on the side. That has obviously shifted now today, where we have full-time investment strategy staff, but we still do want, as Jared mentioned, wealth advisors as part of the committee to provide that grounding with the client experience. I'd say the next big change was back in 2011 when we worked with our partners at Bridgeway to launch a small cap value strategy. And what really led to that small cap value strategy was something that happened a few years earlier, where Dimensional had to soft close their micro cap and small cap value funds. And the reason they had to soft close those funds is that those funds were really, really good at what they were doing. So they were able to, if you wanted to have a strategy that could deliver the returns of small cap value, there was nowhere else you should go than Dimensional at that point in time, because they were so successful. But they attracted a lot of assets, and so eventually they had to soft close their strategy. So we started to look at what our available options were in the marketplace, and certainly DFA had their targeted value fund, which is more of a small/mid-cap value strategy. But we really wanted that true, deep, small-cap value exposure, and we found a company in Bridgeway that was willing to partner with us to create that strategy and actually limit the capacity to just our advisors, so we wouldn't run into that same circumstance again. So we worked with Bridgeway to launch two strategies, their tax-managed small value and non-tax-managed small value strategies back in 2011. And I should have mentioned, too, the relationship with Bridgeway goes back a long, long ways. So Larry had a relationship with Bridgeway's founder, John Montgomery, going back to the 90s. So we don't do anything all that quickly on the BAM side. We're pretty slow to implement anything new. And I think that's an example where we have a relationship for more than 10 years before anything comes into the portfolios. But in terms of the Bridgeway fund, it is a very deep small cap, very deep value strategy. And it's performed pretty much in line with expectations since it is launched. So during periods when small and value does well, it will tend to outperform its competitors in DFA or Vanguard, and then vice versa. When size and value do poorly, like it has recently, unfortunately, it will tend to trail DFA and Vanguard because it is so much deeper size and value tilted. Next big change we made in our portfolios was back in 2017 when we incorporated alternatives from AQR and Stone Ridge. And really what kind of begat that change were really sort of three things that we were looking at before implementing it. So first was we were looking for strategies that would have very strong academic and practitioner evidence in support of those strategies. So anything we would implement, whether it's stocks, bonds, alternatives, would have to pass that first test before we would even consider it. And then the next two kind of forward-looking expectations items that we were looking for were, number one, we wanted to find strategies that would outperform, say, fixed income, and number two, have low correlation with equities. And so we believe that these strategies will, over the long term, satisfy those two goals as well. To date, again, it's been a relatively short period of time. The strategies have had very low correlation with equities, so that's been good. If you combine them together, they have trailed, say, fixed income here so far, but again, it's a relatively short period of time up to this point. And so those are kind of the major changes in terms of the portfolio that we've made over the years here at BAM. To give a sense for what our AUM looks like, and I realize the colors are a little bit difficult to read when projected up on the screen, so I'll just kind of walk through each one. This shows BAM, and this combines both Buckingham and BAM, AUM by fund family. So roughly 2% of assets are with AQR, 4% with Bridgeway, about half with DFA, 1% iShares, 3% Stone Ridge, 5% Vanguard, 20% managed in individual bonds by BAM's fixed income desk, and then 15% in assorted other mutual fund families. So that can kind of help give you a sense for what our overall allocation looks like by fund family. And I should mention, too, that this isn't all decided by our IPC, because each, on the BAM side anyway, each firm is responsible for their own decisions, so they can choose to do what we are doing with our model portfolios or not. So it can look very different from what like a Buckingham model portfolio might look like, for example. So I'll stop there and pass it off to Jonathan to talk about the history of the Loring Ward IPC.
Great. Awesome. All right. Thank you, Kevin. So our history is actually pretty similar. We started a little earlier in, I want to say 89 and 90. We really got going servicing the advisor community. So I have a similar timeline here with some different pictures. But you'll notice we had a book, same time frame. And then I'll walk through some of these different people up here. So our genesis really is serving the financial advisors. Started with those three gentlemen up there. You'll recognize this is John Bowen, that is Carl Reinhardt, and Alan Werba. All right, so they formed RWB. They actually had individual businesses before and they partnered up earlier, but Carl is actually here in the room. So one of our founders is still practicing advisors. So if you have got any questions on this, and Carl, you can critique my presentation here of this timeline. But the story is John Bowen was teaching at Golden Gate University, just a local university, about modern portfolio theory. And so he was educating students on here's how we should be managing your portfolios. Then he went back to how they were putting together their own portfolios, and they weren't doing it that way. And so they said, you know what, we should really be practicing what all this academic research is telling us and what we're training these students to do. And so that's when they started searching for how to put together asset class portfolios and implement in a diversified fashion. Their early portfolios included some DFA strategies, some Vanguard strategies, and some active strategies. What they found very quickly, and you actually heard Alex Potts share the story yesterday, is that they had a small cap manager in one of their asset classes that didn't stay true to their mandate, right? And we see this in a number of studies to this date, that active managers have a hard time of sticking to their asset class. They like to drift, they like to add value in different ways, but when you're in our seat and you're trying to be an asset allocator and put money into specific asset class mandates, that drift you don't want, right? You want your manager to stay on target for what you hired them for. And so very quickly, that was some of the work that Alex helped with the team at that time, was they moved over almost to entirely DFA-based portfolios in the early 90s. Dan Wheeler, if you guys know that name, was very influential in introducing him and the firm to DFA, and then the rest is really just history with us. So I'll walk through some of the timelines. In the beginning, we had, I put this little timeline on the bottom here with these numbers as 4, 5, 20, 25, 3, 15, 7. Those are our number of portfolios that we were kind of offering as our standard models. But similar to what Kevin was saying, advisors use those as starting points, right? So advisors with us could totally customize, and that customization could be client by client if they really wanted to be that detailed with the type of customization that was available. Mayor Statman joined in, I want to say, 95. Mayor Statman is a leader in the field of behavioral finance. He's a professor at Santa Clara University, so Santa Clara is a neighboring city to San Jose. Alex went to school at Santa Clara. Mayor was already publishing on behavioral portfolio theory at that time. He introduced this concept of a pyramid, which is a little different than the Maslow pyramid, but it was more about needs, base, and wants, and how you can allocate your, he was using it to justify why people were buying risk-free bonds, then also lottery tickets, right? So they have multiple goals. They have this desire not to be a bag lady, and then they have this desire to be rich. And so people can think about their money in compartments. And so we really gravitated towards that. And for a period of time, he actually was our chief investment officer and was contributing. We published a great book, The Prudent Investor's Guide to Beating the Market. So this was fantastic because advisors were able to use this. It communicated what our value was. It communicated how we built portfolios. I always say it was a blessing and a curse, right? Just because I think it does a great job of describing how our investment style can add value over time. The curse is that it sets this target of the market, right? And we know now, like as we've expanded and lived through different cycles, that the market isn't our main goal. And we just saw George Kinder talk about the different ways that we need to focus on the life, which we're all out practicing. Funny story is that I got this book. I purchased it from Borders, if you guys remember that story, or that store. And I still have the book and it had the price tag on it, which was pretty funny. But I got the book before I even knew where RWB was located and what was going on. But the funny thing is, who gave the book to me? And that was my dad's stockbroker. Little did he know that was one of the books that would be the downfall to his entire business model. But maybe he was just putting me in the right path. So it was great just to get that exposure. And there was another version of the book, second edition, that was published. And then we've had other books through time as well on the investment solution, and then Dan Goldie's book on the investment answer. We launched a fund complex called the SA Funds in '99, so we just had our 20th year anniversary for that complex. Those funds were developed as a way to put our fee inside of the mutual funds, right? So one of the ways, so for all the BAM advisors, the way that we charge our fee is as a separate fee. So our fee is applied in addition to what the advisor is charged, right? So those are two fees. Or we did have a model at the time where we were combined. But some given the popularity of companies like SEI at the time, they had all their fees internal. People wanted to have as little a fee outside as possible, so we supported that. And at the time, and to this day, DFA is subdividing all of those funds on our behalf. We came out in the about 2006, 2007 timeframe with structured investing, where we ballooned the number of portfolios. And what was going on was we kind of had these 25 models, which were just five risk types and 5 variations on how much international exposure that you wanted. And so everything from the tilting standpoint was set, how much value and small that you had in the portfolio was pretty set across the board. And when we expanded to this 315, we started, we were doing work with Mayor, and we were getting into preferences, and people wanted, and we had already lived through the late 90s, and so we were trying to go and implement some of the lessons that we took from there of, hey, there's tracking error or tracking variance, as we've heard it now referred to, which I think is a great term. So we started to give flavors, kind of like there's the RT1, RT2, RT3. We gave 9 choices, and so that's why the number ballooned so much. Then I'm going to skip. We'll come back to him, but then just on the portfolio side, we went and became a strategist, and on strategist platforms, this is where, if you don't know what that term is, broker dealers, they'll have platforms for their representatives and advisors to go on to, and then it's kind of a supermarket of different model providers. And so we started to be a model provider in the late 2000s, and we couldn't go in with 315 models. It would just be way too much for us to maintain, way too much. They didn't want that many choices, so we had to narrow it down to 7. So we narrowed it down, and that became kind of our core strategies. We added 2 risk tolerances, and that has evolved into what we're referring to as our global portfolio series, and you can get that through our FSP program, where we actually take care of the ongoing management in your client accounts. But right before that happened, Harry Markowitz joined the investment committee, and his influence obviously in the space is well known, and he was extremely helpful in refining that process and helping us really quantify everything that we needed to do, which led to a number of these innovations that were later here. The development of our forward-looking capital market assumptions, right? So we have to go, we use optimization. That started when we came out with structured investing. We use optimization to build our portfolios. We obviously use behavioral constraints to contain and accommodate some of the issues with optimization. But we really like what we've been doing with our capital market assumptions, and we're excited to be working with the BAM team to enhance them and evolve them. We also came out just late last year, this year, with our after-tax optimization process. So another evolution in the way that we do our optimization. So now we go in and adjust our capital market assumption return assumptions for taxes, and that just helps because we have a number of series. So while we're a list that we have just 7 risk targets, there's 6 ways that you can actually access those. There's 2 SA fund options, there's a DFA option, there's a DFA tax managed, there's an SRI, and then there's a sustainability option. So we've got still a number of portfolios, but the nice thing is with all of our portfolios, the asset class is, the asset allocation is the same, the way it's implemented just changes. And then finally, I think this is a real big time saver for all of our advisors, and so this is now, we call it our Fund Strategist platform. I mentioned it as FSP. This gives us the ability to go in and change client allocations as we go through our annual update cycle. Because at Loring Ward, what we'll do is every year we'll update our capital market assumptions in the first quarter. We'll then look at how the asset allocations are impacted by any of the changes, and then if we think the changes are meaningful enough that we want to actually implement them into our portfolios, we'll put those out there as recommendations. Now, historically, in our business model, everything was off of a client signature. So every client that you had, they had to sign on the model allocation form, because we didn't have discretion. We still don't have discretion on those models. So if you wanted to go and implement a new change and you had 100 clients, you'd have to go and do 100 client meetings to get 100 signatures, right? So it's a little hassle. So this year we rolled out something that allows advisors to really scale the implementation side. And so you can identify your portfolios as FSP, and then we'll send negative consent letters, because we still don't have discretion, to the client 45 days before we make the change, informing them of what's happening, and all those changes will be done automatically for them. So they get the benefits of the latest and greatest thinking that we're putting together in our portfolios, and they don't have to go and get the client signatures. But we give them a lot of tools to help them with that communication process. So the last thing I want to mention is, we didn't talk about Mayor Statman, we didn't talk about Harry Markowitz when Jared was walking through the investment planning committee. They are still involved, there's just a different committee, right? So a number of the members on the investment policy committee are also members of what's called an investment research committee. And that's where Mayor and Harry are as well. And so we meet quarterly with them, and walk through current research, things that they're working on. We get their feedback on different ideas that we want to have. So that's a different team with a different meeting frequency and a different focus. But they're still good contributors to our thought and the processes that we use. So with that, I think it's time for Jared to take us to the next section.
Yep. Only 50 more slides, so hang in there. So last one, so questions at the ready here. So just wanted, before we get to questions, to talk about the future of the IPC in terms of what are some of the things that we're working on, particularly related to the integration. So I'd say next year is a huge year for us on the integration front. We've obviously integrated the investment committee, but there's a lot of like real practical work that we're going to be plowing through to kind of integrate the investment strategy side of the offering that'll be happening next year. We've talked about the capital market assumptions, so certainly that's going to be a big one in terms of making sure, or trying to get to one set of processes and routines in terms of the capital market assumptions that are, applying to the planning models that we're using and anything else that they could be applied to. So that's certainly a big one. Next generation of model portfolio strategy. So I don't yet have a great timeline for this, but in terms of thinking through, basically we've obviously now got a huge set of model portfolio strategies across the two sides of the business. So thinking about what should the next iteration of those look like, how do we slim that down to some degree to the extent that that's possible. So that's certainly going to be, again, a second big one that we're going to be working on in 2020 that certainly will impact all areas of the business, but still try to be done in a way that's sensible as we go forward. Another big area for us is the ESG SRI front, and certainly in terms of making more headway there, being able to communicate more clearly to both our advisory teams at Buckingham and the advisory services side in terms of what do we think is best to do for clients that need to implement some type of ESG SRI solution. I think on this front, there'll likely be both a mutual fund ETF-based component model there, similar to things that we might already have, but I expect a big part of what we're going to be trying to do here is look for separate account solutions there that provide more robust ESG SRI solutions through firms like Parametric, Aperio, others where there's a little bit more ability to tailor what those solutions look like. And then on the alternative side continues, even though the last 18 plus months have not been fun, here continues to be something that we look at and believe can be an important part of a portfolio. So nothing imminent there, but there are strategies that we're continuing to look at there that may be added eventually to the alternatives portion of portfolios. So those are some of the big things I think for the next year plus that we'll be working on. So at this point, we'll have Daniel, I guess, kick us off for the Q&A.
Yeah, Daniel, yeah. Thanks, Jared. So, thank you, Jared, Kevin, Jonathan, for walking through a little bit of the history, a little bit of what the IPC is working on. One question, as folks kind of get ready with what you want to ask, that I've heard a little bit from advisors that I'm talking to, and maybe, Jared, you can kick off a little bit here. What are the major philosophical differences that you've noticed in terms of model portfolios, investment strategy between Buckingham, BAM's IPC, and the Loring Ward's IPC?
Yeah. So I think Kevin and Jonathan have certainly covered some of the pieces. Obviously, they're very similar at a high level. It's the type of thing outside of like an advisory audience. Most individual clients probably wouldn't know the difference in terms of what we're doing. So very similar. They're obviously low cost, tax efficient, mostly mutual fund based at this point. I think the things that stand out as some of the differences would be fixed income. Again, obviously we've on the BAM side have implemented primarily individual bond portfolios when we're building out the fixed income solutions, at least for our clients at Buckingham and even on the BAM side. A few more fund companies that we're utilizing, which is something we'll certainly sort through, and then some alternative strategies that we're utilizing. So those are the ones that stand out to me. Again, super high level though, very similar ways of thinking about investment philosophy across the committee members and firms there.
Great. We'll open it up. Is there any questions? Yes, please.
Absolutely.
So the question, I'll repeat just to make sure. So questions around the future of the SA funds, whether they'll integrate into BAM and whether they'll continue into the future. Jonathan, you want to key off?
Happy to speak to that. So we absolutely, I mean, they're part of our past, and we see them as part of our future. And we're actually looking at different ways to utilize those structures in, with potential other partners. So potentially expanding the options that are available through SA funds, and then also in the BAM community, right? Because there's with the packaging the way it is, it helps accommodate some of the fee challenges we've seen that some advisors face. Right? Maybe smaller firms. It could be a really good solution for smaller BAM alliance firms because they're subject to a minimum, and we'd be able to help them facilitate using those strategies, staying involved in the community, and growing their business just at their pace. So that's one application. There's a lot of other applications that we're discussing in ways that we're looking to just solve the needs of the advisors that we're working with.
Good question. Yes. Right here.
An SA fund, so it is a complex of mutual funds that we created about 20 years ago as a way to put our fee inside of a fund structure, so we didn't have to charge our fee on the outside. So they're all sub-advised by Dimensional Fund Advisors, and there's a number of individual strategies, and then there's one moderate growth portfolio, right? So if you truly have a small client, you just want to put them into one solution, you have that, and that's a blend of other SA funds.
When you say fee, are you talking about just, you're talking about the advisor, our advisor fee plus your fee, or just like the fee?
We're just talking about our fee. Okay. Yeah. It's a challenge for us to put in an advisor fee into that structure.
Great. Jeff, yes.
Yeah, so as we look at valuations in these challenging times, it's clear that the market, the S&P 500, call it core, might or should underperform in the future. The rest of the portfolio, if you look at the valuations, should outperform theoretically in the future. Why did the projected equity assumptions go down?
So the question here is on projected equity performance, and I assume in the capital market assumptions piece. Kevin, would you like to take that one?
Yeah, I'm happy to. So I'd have to look and see which ones specifically went down, but what you would see in the capital market assumptions is something similar to what you just described, with U.S. expected returns lower than ex-U.S. If there's any change, it would likely be due to valuations moving one way or the other.
But U.S. core, not value and small value, right?
So you're not asking. So are you asking about U.S. versus ex-U.S. or like large versus?
I'm asking why the equity return that we're using for projections went down when most of our asset classes are at low
I got you.
valuation.
Yeah, so a change we made, I want to say at the beginning of the year, was to further reduce the amount that we're expecting from the premium. So we had always incorporated a discount of historical premiums, basically saying that you're not likely to get the historical premium moving forward. So we had always incorporated some sort of discount within our capital market assumptions. We've increased that discount a little bit is likely what's going on there.
And Kevin, can you talk about a little bit of that too? Is that consistent with the research that you're reading, or what was the motivation?
Sure. So yeah, that is consistent with the research. So there's a famous paper by McLean and Pontiff that shows that on average, premiums post-publication are about a third to a half smaller out of sample versus what you saw in the paper, which indicates either there's some data mining, overfitting, however you want to describe it in the data. But then also, once something becomes published, then there's probably more dollars chasing those strategies. So it's sort of hard to disentangle these effects, but at the end of it, you wind up with a lower expected return than what you see in the historical data for a lot of these factors.
Great, thank you.
The other thing I'd add that we've looked at that's, I think, part of the recent iteration of this, we've looked at, obviously Dimensional has a couple of small value funds that have existed for a long period of time. We've looked at the excess returns of those funds compared to the data series that Ken French publishes, and their excess returns have been about half of what 10 series have achieved. So that gives you some sense of, in the real world, how much of this is translating from, say, academia into the real world, what's been captured, and the excess return's about half. That's perfectly fine. You wouldn't expect it to be the same size, but that's another thing that we've started looking at, as those two series have 25 plus years of history to look at how much above the market have they captured relative to the academic iterations of those series.
I'm going to add just a comment and take it a little different, because I interpret your question a little differently. So if you look at performance over the last 10 years, and if you just take the markets, right, so the U.S., international, emerging markets, right, we know that international emerging markets have been the ones that have underperformed, but even in the U.S., value stocks have delivered historical returns for value stocks. So if you went and looked at like a Morningstar style box, and you looked at current valuations versus the last 20 years, in 8 of those boxes, you're at 100% of what that value is or more. The only one that you're a little under is in small value. But the overall market is now at it's at or above its historical average. Now you go outside the U.S. and then that's where you start to see some differences, and that's where those differences are going to come from. So even though our tilt in towards small and value in our portfolios has underperformed, it's still giving you performance which has been driving up the PE ratios as just one example.
Good example. Another question. Yes, over here in the blue shirt, please.
Question about the BAM models. First off, on the alternatives, you're feeling on commodities in addition to real estate. And then the second question is why the alternatives like commodities and real estate are the same percentage of the overall portfolio? You're a 30% equity model, and same when you're at 60%, we're already got 80 million alternatives. Like real estate will go from 3 to 30, stay at 3, so you got 80% will go, and then only 4 why it's not more relative.
Yeah, so a couple questions here before Kevin. So we got one is basically thoughts on commodities, if I'm hearing correctly. And then the second question that we're asking is how are we defining how much we're going to allocate to these alternative asset classes based on the equity to fixed income ratio. Kevin, you want to take that?
Sure. So on the first part of the question, so when we rolled out our latest version of the alternatives, they did not include commodities specifically. And really the thought process there wasn't that there's necessarily anything wrong with commodities, it's just that we realize that all of the alternatives that we're rolling out are tax inefficient, and so you're not likely to have a ton of space in tax advantage accounts if you want to include these other alternatives, which we think will have higher returns, higher expected returns moving forward. And so that was why they weren't in the latest version. But we still have approved commodities funds, still think that they can provide protection against unexpectedly high inflation, so they can make sense in certain circumstances. And we still have, we don't have a pie chart for it, but I want to say 100, 200 million in commodities across Buckingham and BAM, so not an insignificant number of dollars in commodities still. So that's on the first part of the question. The second part of the question, the reason we scale real estate up with the equity is that while we classify real estate as an alternative, because pretty much the rest of the industry does as well, we kind of think of it as sort of a hybrid or more like equity than a true alternative. So if you look at, no matter how you want to look at it, correlations, if you want to run regressions on the returns of real estate, they don't really look like a unique factor or unique source of return. They look more like an equity sector than anything else. So that's why we scale that up with equities on the real estate side, but not necessarily on the commodity side, because we do think that commodities are a unique source of return. Real estate, not as much.
Yeah, and I think, because I want to make sure we get to this question, so I think you may be also looking at older iteration of the models, because it's a fair question in terms of like for low equity allocations, I think, which was your question, kind of.
30%.
Yeah. Right. So that's something we've rethought with the latest. Like if you look at the latest iterations that include alternatives more broadly, but not commodities, that's a decision that we've rethought there, because it does lead to some weird dynamics potentially as you get to really low equity allocations, particularly the REIT to equity ratios there. Yeah. So yeah.
And then keep in mind that the mutual funds that we're using for equity exposure typically exclude real estate positions. So at a minimum, we're adding back to get us market exposure because most of the S&P benchmarks, Russell benchmarks all include real estate exposure.
Good question. And the black blazer, please.
Question regarding what your screening process is regarding what other fund companies, how you come up with existing fund companies that you're using, and then what happens. I have a long related with West Wellington. I want to come back to the LPL. And when I read Bowen's book, I called it, what'd you do? Why'd you go from LPL when you had a great Gabriel on the ground and come over to the mission? But I'm really biased because of my history with DFA. And I get real squeamish when I'm looking at other mutual fund companies, because one thing Weston told me early on was that those fund managers don't always stay consistent in the asset classes that they're in. And then when that happens, what do you do?
So the question here is really around kind of what does the IPC do to, what's the process for approving new securities, new fund managers, and then what's the ongoing due diligence to make sure that these companies are staying true to what they've committed to do. Jared, you want to start?
I can kick off on that one. We probably all want to chime in on this one. So on the equity fund side, which is probably what's most important, certainly, we're looking at for low cost, tax efficiency. To your question, we are looking to make sure, are they staying consistent to the style that they're implementing, which is essentially, are they following a rules-based approach, or maybe they're purely indexed? So I would say on the equity fund side, if you look, you may not have seen what we call our approved securities list, which is a lot of funds at this point, not all of which are in the models. But basically on the equity fund side, all of those funds would be basically low cost, essentially tax efficient, rules-based strategies, either explicitly rules-based around an index, or say like a Bridgeway strategy where there's just a certain set of rules that are effectively kind of creating a homemade index. And we have a process that we run basically every quarter that the investment analysis team helps with to make sure the styles are maintaining their consistency over time for the fund. So yeah, those are some of the things that we're doing there, but I would say kind of holistically all the funds on the equity side are kind of doing similar things in terms of rules-based approaches with some notable differences, but all kind of have some things in common that they're doing.
Question with Bam, but on the bond side, the Mobley Group, what Major Lloyd does on the bond side, we certainly challenge today, tend to be more CDs than anything. To the extent of what municipals make sense on the ladders, but certainly that's a big concern of ours. And I know there's a lot of evidence to support what we do on the BAM side, but clearly, like maybe if there is a different view, or how you guys look at bonds.
Yeah, so the question's around the fixed income side of the allocation and how we're implementing fixed income, specifically what Loring Ward's done historically, and then I think kind of piggybacking on that, what I'm hearing is there's some concern about just a lot of brokered CDs on our fixed income ladders. And so, Kevin, you can maybe talk about a little bit of why we think brokered CDs can make sense in portfolios.
Yeah.
Jonathan, you want to kick it off?
Absolutely. So we are aligned from a methodology standpoint, right? So we prefer shorter term horizons, right? So on the bonds, right? So our duration is probably half of what the Barclays Agg is, right? So the duration on our portfolios that we put together are about 3 years. And that actually just went up. I'll kind of explain. So historically, and it's all high, and it's predominantly higher quality, which is aligned with what BAM does. The way that we've implemented it in the past, so historically we would use the DFA 1-year fixed income and then the DFA 5-year global. We would have that kind of those two strategies, and we would allocate half of the fixed income towards the 1 year and half towards the 5-year global. Then we've been watching that 1 year because as rates have come down and as they stayed down, we're losing money on a real basis from that fund. So this year, when we did our fund updates, we replaced the 1 year with the DFA short-term extended quality. So that gave us it gave that fund allocation a little more range, and we also took off the allocation 50-50. We let the optimizer kind of adjust it for us. And now based on where the more optimal duration is going to be for the mix of equity that we have in a portfolio. But I think there's a ton of similarities, right? So are you familiar with those strategies? Yeah, so those are the ones that we're using right now.
BAM really uses the funds if it's a large enough account, we'll certainly manage it through the bond.
Yeah.
And of course, municipals will be grouping as well. But yeah, there's a lot of conversation about, credit and, let you guys speak clearly on that because, I'm personally concerned about, that maybe we don't buy globally or certainly it's domestic and it's, you guys know the story, but it does feel very challenging, certainly at the moment.
Yeah, just to quickly chime in on sort of the BAM side of it, for sure, it's been a challenging environment in fixed income now for years and years and years, and unfortunately, we felt like we were coming out of it, to start this year, and now we're kind of right back to where we were about a year ago. So. We continue to look at other options that are out there. So, it's one of those things that just because the recommendation tends to consistently be brokered CDs or munis, it's not that we're not looking at other investment options that are out there. So we're constantly looking at other types of securities. Like, do we look at lower IDC score rated CDs? Do we look at perhaps lower rated munis as an example? But every time we look at these other options that are out there, you're not picking up that much yield for the amount of risk that you're taking. It is kind of the perspective that we would share. Because if you look, and it's not just in the things that we look at, but if you look at triple B versus double B, or across the landscape, the spreads are just very, very narrow right now. So you take on more risk, but you don't get that much yield pickup right now, no matter where you look, whether it's term or credit right now.
Yeah, and the perspective that Brian would share in the fixed income session too, for those of you that were able to sit in, is that everybody's chasing yield right now, and when that happens, you're just competing those prices up.
Since you've had this wonderful merger of the two, is it possible to put together one sheet with Swedroe, Markowitz, and Statman as you research, and then you guys as the investment committee, something that's kind of like a show and tell for advisors, not like those responsibility things that you have for the investment committee? I think that would be a nice piece to put out to show what's behind the selection of the portfolios.
Yeah, so the suggestion here is around, is there a marketing collateral that we can offer to help support the story of, who's really behind a lot of the thinking here?
Yeah, that's actually available right now. So it was. I don't know if we distributed it through our email communication, but it's on our website for the Loring Ward advisors, and I don't know if it's made it over onto the.
Yeah, I'm not sure if we would have released that through the bulletin or not. Yeah, it's something we can look at, but yeah, it is available.
We can send it over to you, or shoot us an email. And anyone that wants it, just contact your relationship manager or the investment team, and we can get it out to you.
Great. Yeah. So the question's around the alternative strategies and whether there's lower cost solutions out there for similar strategies compared to what Stone Ridge is offering. Jared, you want to?
Yeah, I can give you some color there. So we're certainly looking at the only other reinsurance vehicle with any history on the reinsurance side would be Pioneer's reinsurance strategy, which we have approved, and I'd say there's a decent chance we're going to end up adding that to the models relatively soon, because it is at least, I think, 50 basis points cheaper. We've had a lot of dialogue with, but it's had good relative performance. So we're looking at that. There's not a lot else in that particular area, at least in 40 Act registered structures. And then on the Lindex side, basically, unfortunately, there is another vehicle that we really, really like, but it's an LP form from an asset manager called Colchis Capital, who's actually the longest tenured kind of manager in this space on the West Coast. But it's purely an LP vehicle, which has just not been a path, at least at Buckingham, that we've been willing to venture down. Yeah, just a liquid, everything that goes into like an LP-related vehicle, but very, very good approach, very experienced people in this space, probably slightly lower expenses. It just has the negative of the LP structure with it. But we're continuing to look at particularly the interval fund space, new launches, new vehicles. I think that space is going to just continue to grow and grow over time. But at this point, it's still for the two asset classes that we have in the portfolios, it's still relatively limited outside of the one Pioneer piece there.
So yeah, so one of the questions that I have heard quite a bit is on the fixed income side, not only about the credit exposure, but why in the fixed income side are we see ladders shortening, and are we going to make any other changes given what looks to be a really low yield environment going forward?
Yep, so on the first part of the question, the reason the ladders are shorter is that we sort of take a similar approach to Dimensional and their global strategies, where we take a variable maturity approach. So when curves are more steep, the ladders will be longer. When curves are more flat or inverted, then they'll tend to be shorter. So as we think about the ladders, they'll be anywhere from 1 to 10 years or 1 to 5 years. Right now, curves are so flat that we're basically building ladders 1 to 5, and that's based on the academic evidence showing that you've essentially assumed that the yield curve is the best estimate of the right price, and you only take that duration risk when you're actually rewarded for it. So that's the approach we take on that side. I mentioned some of the things we've looked at earlier in terms of looking at lower IDC score CDs, looking at perhaps lower rated munis, looking at corporates, looking at all sorts of different things to maybe eke out a little bit more yield. But when it comes, at least from what we've seen so far, of course this stuff is always subject to change as the environment changes, but from what we've seen so far, there's no real reason to make any changes because you're not picking up enough yield to really make it worth it.
Jonathan, one question for you that I've heard and I've heard Jared give an explanation, I've heard Kevin give an explanation, but what's your response when you talk about U.S. performance versus ex-U.S. performance with clients? How are you describing the discrepancy in performance, and how are you answering the question when advisors or clients are asking you, Japan, Europe, all these places look weaker economically, why don't we invest more U.S.?
Yeah, so there's a couple ways I handle those conversations. I give a presentation for our advisors that want to learn about our philosophy, and I break it down into 3 decisions, right? So write these down if you want to. I talk about these trade-offs, right? The first trade-off is between being tactical and strategic. The second one is between being market tilted or factor tilted. And the third is between active and passive. So when I work with clients, I usually work them back to one of those 3 decisions, right? So if they're asking me a question about changing an exposure from, maybe we're at 60-40, right? That's what our standard models are. Similar to the BAM models, we're 60% US, 40% international. I talk about timing, right? And I talk about the challenges of timing as one of the approaches. And I bring up studies that talk about how tactical allocation funds, mutual fund format, have a really hard time beating a 60-40 Vanguard portfolio. Only 1 in 10 can actually do it over a 10-year time frame. They don't outperform over the long term, and they don't realize additional benefits on the downside. They actually perform worse on the downside. So that's one angle, right? So I talked about what they're asking to do is basically time the market. Like here, we want to switch from one market to another based on academic evidence. And then the other is they just remind them very quickly about the lost decade, right? So what happened in the 2000s, right? And very quickly they're like, oh yeah, this isn't always the case, right? If you look back at the last 5 decades, only 2 of them the U.S. actually outperformed. So historically, international actually been better over, when you look decade by decade now, over the entire time frame of this run that we're seeing in the U.S. They've taken over what the international was. But those are usually the 2 areas that I focus on, is just kind of addressing kind of the recency bias, right? And because there's always issues out there, right? This market's climb a wall of worry, like that's so much worry, right? Market prices are already impacting that, right? So I guess that would be the third point, which is, hey, that stuff's already getting priced in. You're not the only one concerned about it. So let's focus on other parts. Let's focus on all the life stuff. Let's focus on what our process is and keep alignment towards that.
Great. So one last question before we adjourn is, for folks having these tough conversations, performance, what resources are available, whether it be on the BAM side or on the Loring Ward side, to help with those discussions? Kevin, you want to talk a little bit about what you've seen on the BAM side, and Jared, maybe comment?
Sure. Yeah, so I mean, I think the kind of go-to resources for me on the performance-related discussions, number one, try to pick out a couple slides that work for you. So we put out a ton of slide content. I typically don't, when I'm in a client meeting, don't want to overload the client with slides, but if you have one or two that can help really make the point and help steer the conversation, I think that can be really helpful. Another resource that I tend to go to a good bit is looking at some of the Larry blogs that he writes. So he writes pretty much every day. So if there's a topic that you're being asked about, there's a 70% chance he has an article on it that's not scientific at all. Or a third place I'd consider are the webinars we do. So I do a webinar with Larry. Jared does one with Brian Haywood. We each do a webinar once a quarter. So 2 out of 3 months, you're getting investment strategy related content, and that content is pretty much always ties back to questions that we're getting asked by advisors and clients. So that can be helpful too in kind of getting our perspective on what's going on in markets and what we're getting questions about.
Yeah, I was going to add on, you're starting to receive some of the documents that are available from the Loring Ward side, so everyone in the BAM. There's 3 pieces that are now coming out through the BAM bulletin, and then they also come out through advisor news on the Loring Ward side if you're not aware of them. But those 3 pieces are, every quarter we do a quarterly commentary. This is a 2-page market update. It's really simple, basic. You've got an ability to drop your logo in there and your disclosures, and then you can send that out. I was just chatting with a BAM advisor who said he did that, posted it on his social media site. Said it had 1,000 views. So it's just getting his name out there, getting some content out there. That's aligned with his thoughts. So that's one. The other is every quarter we put out a quarterly perspectives presentation that gives you talking points in a very straightforward fashion that walks through what how factors are performing, how international markets perform in the U.S. markets on a relative basis, and bond markets. We break down these factors of return, and then we cover some perspectives, what's going on that we need to pay attention to. We publish that in a PDF, in a PowerPoint, and even in a YouTube video. So you can forward those videos. They're about 10 to 12 minutes to your clients if you want to. Post it on your website, post it to your media feeds. And then the third one is a monthly letter, your monthly investor letter. So those are coming to your inbox now as well. Those are shorter and sweet, very conversational pieces about how to interpret what's going on in the marketplace. You can go through, you'll get them in Word and a PDF that you can customize if you want to, and just send those to your clients. So there's a lot of resources that are available in the bulletin. So if you've been deleting those, make sure you open them up now, and start looking at the material and start clicking through, because there's a ton of stuff coming your way.
I'll just add there, so I've been in a lot of individual client conversations with our wealth advisory teams. So kind of similar to Kevin, I'd say pick out a couple of slides. One tactic that I found that seems to be more effective than others is trying to draw a contrast of the most recent decade to the prior, because you can bring out a lot of good points, with the ex-US, US value versus growth. The other thing that I've seen that I think is super underrated is, even if you look at the last 10 years for, say, our Risk Target 3 portfolio, which on the BAM side, one of the more commonly used models, basically been kind of at returns equal to the MSCI ACWI. A lot of people are surprised by that, think that there's no way that can be true, but it is. So what it tells you is what we've really had happen, as we all know, is kind of the U.S. Blowing the doors off of everything else, compared to the global equity market. So I found that approach of trying to bring out some of those slides that can help remind people that this is not always the way things are. The U.S. is not always the dominant market. We've got some good slides that show kind of across the different developed countries what returns have been most recent decade, prior decade. So there are a handful of slides there that I'm certainly using over and over, unless there's something like super specific that a client is asking about, then I might go a different direction. Otherwise, I'm kind of using the same 4 to 6 slides kind of over and over again for those individual client conversations.
Well, with that, we'll adjourn. Thank you, Jonathan, Kevin, and Jared.
Thank you.